John.
Merryn.
Happy New Year. I missed you.
I missed you too. Happy New Year.
Yeah, and Happy New Year to our listeners. Very kind of you to still be with us. Now, listen, John, this week is an exciting week, or rather, everybody thinks it's an exciting week, or maybe it's a depressing week. I don't know. It's the 40th anniversary of the beginning of the calculation of the FTSE 100. But, I want to be absolutely clear. All the other columnists are saying that the FTSE 100's birthday is January the 3rd, but I want to be absolutely clear, and I'm reading here from our favorite book, John, The Stock Market by John Littlewood.
That is a great book.
A landmark around this time was the launching on 13th of February 1984 of the Financial Times Stock Exchange 100 Share Index, FTSE 100, or FTSE as it is commonly called. Simple weighted index by equity market capitalization of the largest 100 companies. FTSE 100 is displayed in real time at 1 minute intervals. 13th of February 1984 was its first day of dealing from a base calculation of 1,000 on 3rd of January 1984. So I want to nitpick. I just want to be clear that you could argue about whether the FTSE 100th 40th birthday was January the 3rd or February the 13th. So we can have another whole round of writing about it in February.
Excellent. Recycle all our columns in about 6 weeks' time.
Absolutely. And the exciting thing is that when it came to the 40th anniversary, I wrote a column, you wrote a column, and John Authors wrote a column, all of which were published on the same day, Wednesday this week. I know what I wrote in mine. Tell me what you wrote in yours. I'm a fan. You a fan?
Yes. A fan of John Authors for definite, and of yourself.
No, I'm a fan of John Authors as well, but a fan of the FTSE 100. I'm a great fan of the FTSE 100. I wrote about how we misjudge it because we don't think about dividends, and we forget that cash is incredibly important, and it just keeps coming. Long-term cash, month after month after month after month, and that cash flow is incredibly undervalued, I think. So, I'm a fan. I'm still a buyer. Well, theoretically.
I agree, and I do think that the FTSE gets a bit of a bad press. One thing I would say, and this is what I wrote in my column, is that after 2008 there was a turning point in that, because people often talk about, oh look, the FTSE has barely moved since 2000, and that's not correct. If you include dividends and all the rest of it, and you need to include dividends because the FTSE is a high yielding index, that's kind of the point of it. So if you want to compare things, then you need to do that. And actually, between 1984 and 2008, it did fine. It was in the middle of the pack for most of that time. It beat Japan consistently, obviously, but also beat the US occasionally, and it kind of beat the Europe and other stages. So it was perfectly respectable index, and that's all in constant currency terms, by the way. So you did fine. But since 2008, it has been a laggard, even if you include dividends and all the rest of it. And I think that's the element that I looked at in my piece, because it has had kind of a rough time between then and now. And I suppose what I think is that there are reasons to think that the things that have been kind of holding it down over that period are now reversing, or have at least run their course. So hopefully now that it's cheap and that the pound is cheap, there's every reason for it to, have a better 40s than it did 30s.
What are those things that have run their course?
Well, there's the whole, two things basically. So there's 0% interest rates, which sort of hammered, actually I didn't mention this in the piece, but obviously they make high yielding stocks less appealing because there's lots of kind of growth stocks become more appealing. But it also exploded the pension liabilities. So the corporate defined benefit pension schemes. 2008 is the point at which the kind of move away from equities just turned into an absolute avalanche. And so all of these defined benefit pension schemes, that's the point at which it'd already been happening, but it kind of really took off, the kind of move into gilts and the move out of kind of UK stocks. But we're now at the point where there really aren't any more UK equities to shed on the behalf of corporate defined benefit pension schemes.
And the other point to make about that, actually, and we've talked about this before, and I do think it's really interesting, is that as interest rates rise, the nominal deficits on those pension schemes fall, they move into surplus. I mean, there's been a bit in the papers about that over the last couple of months. That suddenly these pension schemes that were horribly in deficit, and there was a massive lag on some of these big companies in the FTSE 100, constantly having to shovel money into their pension funds to keep the show on the road. Now they find they don't have to do that anymore. So that should, in lots of ways, free up a lot of cash for these companies.
Oh, exactly. I mean, I can't remember if we mentioned it in the podcast or not, but there was a big one just before Christmas, FTSE 250 company called Coates, and it basically was able to pay off its pension deficit early because of this shift. And now, it was saying, okay, so that means we're going to have, something like the region, I can't remember, it's about 10 million odds extra free cash flow every year, which, was a lot in the context. So no, I think that's the other thing. So if that's changed, then companies are going to have more cash as well, and so they'll become more attractive. But the point is the big outflow from UK equities, it's hard, at least one big factor in that can't really go any further from here, and may reverse.
I did write a column about a decade ago saying when interest rates turn, you should buy all these companies with big pension deficits. Obviously, I was about 8 years too early on that one. I should go and dig it up again. We can recycle that one too.
Well, it's interesting, though, because people forget that it was meant to be emergency monetary policy, and then the emergency just lasted for much longer than pretty much anyone thought it would.
It's not just about the FTSE 100, by the way. There's a lot of pieces out or coming out, and more will come over the next few weeks about how cheap smaller companies are as well. And we've talked about this before, but there's an interesting piece of thematic research came out from P.L. Hunt earlier this week about just how cheap small companies are and about the pace of M&A. 40 transactions in 2023 of over 100 million, the average premium paid 50%, which tells you how cheap so many UK smaller companies are. And if you begin to see money flowing back in there, you're going to see money flowing back into the UK as a whole. And all this kind of thing, it's very reflexive, isn't it? And that the more money that flows out of the UK, the more miserable it looks, and the more money flows out, and the more it underperforms, and the more money flows out, etc. And that can turn on a sixpence. I mean, I'm telling people at the moment, if you think that the UK can't turn fast, look at Japan, which looked absolutely miserable for so long. And then suddenly you're making 10% a year on it. When it turns, it's very quick.
Yeah, it is quick. And I mean, that Peel Hunt thing was actually quite an eye-opener, because it was something like nearly a tenth of the AIM market by value just basically disappeared last year. And not in falling prices, but in transactions, which is, that's a lot. In some ways, the whole of the UK market is looking like, an investment trust that's entered rundown. And they can't realise the actual value of the assets in this massive fund, and therefore they're just getting, nibbled away or chewed up in other ways.
Yeah, it's interesting though. Peel Hunt have a little list of things that might break the cycle. How do you get fund flow up? What can break the cycle? And they have a list of them. Increased appetite by retail investors. So if a British ISA appears, or there's some change to capital gains tax, or a change to dividend tax on UK shares, those things don't seem that likely, do they? Changes in allocations by pension funds and insurance companies, thanks to government incentivization and regulatory change, and to enable a greater focus on performance rather than risk. I mean, that may happen, not necessarily in a way that you and I would approve of, but it may happen. An increase in share buybacks, which may well happen when valuations are very low and there is this tax differential between capital gains and dividends, makes sense that you might see share buybacks going up. And then, of course, there is the thing that we've been going on about for ages. Would it be possible to cut the UK's level of stamp duty relative to other markets? It's incredibly high. Lots of other markets don't have a stamp duty on equity transactions at all. We do, and not low either. Changing that could be a real change. And of course, once something changes, you may begin to see the flows turn around. And then, as I say, it could happen very fast, both for the small caps and for the poor old FTSE 100.
Yeah, ditching stamp duty on shares seems like a no-brainer. It doesn't raise that much overall. And it's not even something, you'd really struggle to make political capital out of that by saying, it's like a tax break for the rich. It really isn't. I don't really see why we've still got it. It's really quite a stupid tax.
Well, because, something rich people. Yes, that. Right. So there you go, everybody. FTSE 100, maybe it's its birthday this week. Maybe it's its birthday in a few weeks. Who knows? But either way, it's time to have a good look at it, I think. Both John and I have written about that, and so has John Authors. So, get to Bloomberg and start reading those things. Now, John, we promised that we would, from I don't know how many weeks ago it was, to have a personal finance tip every week. So what is it? Because I'm pushing this on you because I haven't got one.
Well, I know that this was a rash decision on our part, but no, I just renewed our car insurance for the year, and I have to say it's gone up an awful lot.
He's not telling you about the crashes.
I'm not going to even go there. It's gone up an awful lot, and it's not entirely my fault. I would say, go on the comparison sites whenever you're renewing your insurance this year. Sometimes it's not worth bothering with. And you may find that, when you go on it, that there's nothing there, but I would suggest doing it because if you can cut the price of insurance, it's actually going to be worth it this year because car insurance in particular has gone up a lot, partly because of, inflation in car parts, inflation in car prices, that sort of thing. And do it in good time.
No, I would.
I actually did it with 2 days to spare this time for once, which is actually just about enough, but don't do it the day before.
And you did your taxes in such good time as well. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, a look at Saxo Bank's outrageous predictions for 2024. Steen Jakobsen, Saxo's chief investment officer, joined me to walk through the 8 strange predictions his team has for this year. We started our conversation unpacking this particular outrageous prediction. The US will usher in the end of capitalism with tax-free government bonds.
So I think a lot of people would actually argue we already killed capitalism and there's nothing left of capitalism because, of course, if you look sort of from a free market perspective, today, as you and I talk, we have Japan, the world's 3rd largest economy, have no price discovery. So their bond market has come to a standstill. There's no bid and offers going on. It's really only the government that regulates the price. Which to some extent feeds into other assets, in the case Nikkei. But let me take you through the argument we're doing here, and it very much relates to 2023. I think it's probably the first time in our career, the two of us, that people are putting question marks on the US debt and its ability to be refinanced. So, in economics lingo, we have a stock problem, which is the size of the debt, and we have a flow problem, which is the ever-increasing new issues that we see. Clearly, the reason we hit 525, 530 in the 10-year was that the market simply said, enough is enough. We cannot continue to finance this. So if you could look into 24, and there's already a schedule for issuance of debt in the US. It's very, very, very rich, even compared to a high issuance this year. In other words, there's going to be more demand on your money, the investors' money. And if you extend that sort of argument and saying, okay, if the government is going to mitigate and create some additional demand, maybe one of the things to go ahead and do is to make it tax-free or tax-deductible in terms of these earnings. And if you do that, what is really happening? Let's assume we have a primitive economy. There's only fixed income and equity market. If you, from the government saying, okay, you can have a return tax-free in bonds, which everything being equal, even with prices going nowhere, is 45%. That equates to, with a 50% tax, to 8 to 10% return, pretty much risk-free, against the stock market, which is ending the year at an all-time high. What that will mean to us is that the amount of capital going into the debt financing of the public sector will increase in size and scope. And as such, of course, that will take away money from the smaller but far more appealing, at least to most investors, equity market. And if you do that, of course, you are similar to what is happening in Japan. You're really disrupting the price discovery, and the government is continuously having a more heavy hand in terms of the running of the economy.
So isn't that just an extreme kind of financial repression?
It is. That's another word for it. But I think the end of capitalism is a better headline because we actually need to discuss whether you laugh, but think about it. We are in a situation where regulation, wokeness, the ESG, all of the frameworks that sits outside the actual clearing of prices in the market is getting bigger and bigger. When I started in banking as a trader, for every one trader like me, there was about 1.5 person in back office and regulatory people. Now as I said in Saxo, I'm one trader and I have about 25, 30 people if I have to believe the organizational chart I see. So, the hand of the government is just getting heavier and heavier. And most of its ability to actually help the individual investor or making the market a better place is actually going the opposite way in terms of liquidity for the market.
Okay. And so basically your point is that it's this inability to discover prices in the correct way that tells us that capitalism has come to an end and we now have basically government-run economies, so we're getting close to that point.
Exactly. And when you and I went to school, university, we learned one of the few principles that actually works in economics is that the marginal cost of capital has to be lower than the marginal return on the capital. And if you force the government hand higher, we know that the government sector, both in GDP terms, but also in absolute productivity terms, is far less efficient than the private market.
Yeah. Okay. Well, I think we might leave that very depressing one there and move on to one of your predictions that seems to me to be something of a triumph of capitalism, certainly a triumph for the corporate world. And the headline for it is "World Hit by Major Health Crisis as Obesity Drugs Make People Stop Exercising." Yeah. So, people were very keen on processed food. So the corporate world made piles of processed food. We ate all the processed food and then we're like, oh, I don't really want to be fat. So the pharmaceutical giants have managed to create a drug that will mitigate the effects of eating the food that they created in the first place. Good thing or bad thing?
Yeah, that's really what we ask you. And I'll be very interested in your personal opinion. But let me take you through the argument here. What we're really asking you is, as an investor and as a private individual, is it a society you want to live in where you can buy a pill and then you don't have to be responsible for the actions of your life? One. Two, don't we risk, if we allow a pill to be part of the healthcare treatment of obesity, that we, in the process, is doing people a disfavor? One, because the social mobility, everything being equal, should be reduced. So in other words, people who already do not have access to sporting equipment at home or even a gym membership, people who have to work two jobs to make ends meet, people who have no ability to go down to the local football club, the golf club, going Zumba dancing, or in any other shape or form, sort of be part of society. If we allow these people to be able to sort of have a lower hurdle rate in terms of feeding themselves, in terms of eating junk foods and everything with no consequences, I think we end up in a situation where we are really not helping the cause, we're making it worse. Also, do remember that all of the tests so far have shown that as soon as you're off the pill, you will put on the same amount of weight that you had to shred. So in other words, this pill is either for lifetime or it's something that you need to abandon altogether and really takes responsibility for your own life. The other sort of part of the equation here is the healthcare sector. The obesity rate in the US is closing in on 50% of the population. In Mexico, is above 60%. So if you sit there in a utility function, being a health official in those countries, of course you're going to argue that maybe this pill right now is marginally too expensive to work. But if the price came down by 50% or 80%, maybe this is the way we're going to move forward. We're going to prescribe this to most people who are obese, and in that process, we're going to reduce the cost of the healthcare system. I personally, and I'll be interested in hearing your view, but I personally think that, of course, the obesity drug in terms of the cardiovascular impacts it's had is positive. It's very costly, though, and as you say, the triumph of capitalism here being that the valuation of these stocks is extremely elevated, and they are really in all things. And to be fair, they're really priced the next 10 years to perfection, so much so that most people, in order to justify this price, will have to see, especially in the US, that the healthcare carriers will have to actually support this being under the insurance rate. So, and if that does happen, of course, there'll be excess demand and probably the production will follow. So everybody expected to be on a pill cannot be on a pill. And all of a sudden you see McDonald's and Coke consumption go through the roof, which is really our provocative call here.
I don't know. I'm slightly more optimistic about these drugs than you are, I think. I mean, I look at it and, people always say, well, people have to take responsibility for their own lives and people should eat better and people should exercise more or whatever it is that you want to say. But we've been saying that for decades and the obesity rates go up and up and up and up and up. So at some point we have to accept that it's not going to happen unless we do something extraordinary and incredibly undemocratic to the food industry. It simply isn't going to happen that 50% of America is going to go, well, I'm overweight and I'm going to take control of my own life by changing the way I eat and the way I exercise because, the diet, look at the diet book industry, right? If it was possible for people to want to take control of this stuff and then to take control of it, that industry wouldn't even exist. So I look at it slightly differently to you. And I do buy the idea that if you could get a cheaper version of this drug into the hands of the large percent of the global population that is obese, then you do something amazing to the health profile of the global population. And not only that, I don't know if you've been following it recently, but you can see that these drugs also change people's addictions to other things. So they stop people drinking alcohol. They seem to have an effect on people's drug intake. Now imagine a world without addiction. What would that look like?
It's funny. It's how you read it. What I'm hearing is that you're very deficit. You're really giving out on mankind. You're really giving up on the ability of people to take control of their own destiny, which I think very much is in line with both the political climate, but also the accepted sort of consensus, the narrative of the world. I think differently. I really think the first derivative here would be a massive lack of social ability to climb through the ranks. If you can't afford it already and you're going to get a pill, your incentive to actually move up and it's going to get worse. So to me, it's acceleration. And in terms of the addiction to drugs, it's kind of funny, and I should be careful how I phrase it. But a number of my clients who's been on the drug has actually complained about the fact they lost their social life by being on it, because simply the ability to take a drink and go out for a bottle of wine or a beer and going out for dinners was actually all but disappeared for them. So I'm not sure. I think the truth is somewhere between your, what I'll call, pessimistic and my pessimistic in your view of this. But we are not going to be predicting it. We are just saying, there is a first derivative and a second derivative on this so-called miracle pill. We don't think it's a miracle pill. We think it's another addition to the way of life, and along the lines of what you just argued, people will not be able to change their life, and hence this is going to end up with less social mobility. It's going to end up with more people getting obese, not less.
But shorter term, if an awful lot of people take it, let's say 10% of the obese people in the US take it, that's got to have a knock-on effect to the alcohol industry, to the fast food industry, to the processed food industry.
Absolutely.
So, we've been... I wrote a few months ago about the effect it would have on the fast food industries when I saw how much less pizza people ate once they started taking the drug.
No. I mean, it's pretty clear, but I think when we do these outrageous predictions, of course, what we're trying to force is a non-linear concept. So, and I will argue, with no disrespect, that you are giving me a linear version of it. So there will be a moderate reduction in consumption of alcohol, moderate reduction of McDonald's meals being served. I'm saying that the wider consequences here is that you lose social mobility, you lose the ability to actually address the fact that people need to be accountable. I'll say from a philosophical point of view, what I want the world to do in terms of that, in terms of healthcare, in terms of support for constitutions around the world. All of these are under attack, but the only thing we do is to accept that it's going to get worse.
I would like you to think that there were rational, straightforward solutions to things. I would like to think that, for example, back to debt, we've been more careful around our debt in the UK and in the US, that we could spend less, that we could manage our public sectors on less money. And I'd like to think that that the obese of the developed world would be able to change their behaviors. But one thing that you and I both know already is that isn't happening, hasn't happened for decades, and is unlikely to happen. So surely all we can do is mitigate it.
Yeah, or just acknowledge that we are in the final inning of pretend and extend. I think 24 very much, because it's a very, very clear election cycle, that everything's going to be weighed even worse in 24. But I think ultimately the way and the evolution, both economic and socioeconomic factors, happens is that we test this to the limit. Basically, we break systems down to rebuild them. So I think we are in the final inning, not just outrageously calling on that, but I think we're in the final inning of a world where we are moving towards the end game. We are, baseball analogy, we are probably in the middle of the ninth inning, not even at the top of the ninth inning. And I think in 24 we move to the bottom of the ninth inning, because all the elections that we're seeing this year and the election we're going to see next year is going to be about anti-establishment and going away from actually, like you say, is going to get worse. The accountability on both political parties, but also central banks and individuals is going to be less strenuous, less demanding. And as such, we're going to end up in a position where we're actually going nowhere.
So what happens in the end game, Steen?
In end game, we end up with more obese people on the pill. We end up in a situation where ultimately the US has to introduce YCC, similar to what Japan did. And I think we discussed this before, you and I.
Would you mind just explaining YCC, yield curve control, to our non-experts?
Yeah, so yield curve control means that the government, and in this case, most likely the central bank, the Minister of Finance dictates what the price of money should be. So there's no ability to rates to move up and down, dictated by the market, which creates an artificial stimulus to the economy, similar to what we've seen in Japan. And the point I'm trying to raise is that everything the Bank of Japan and Japan has done over the last 15 years has been repeated by the Western world inside 5 to 6 years. So as often as we criticize the Japanese for what they're doing, we have continued to do everything they ever done, including QE, which was initiated, of course, for many years before the Western world in Japan. So I think we know the future. We can just look to Japan, and that is a standstill economic model. Social mobility, again, very low, but the fact is that Japan can afford it. Most of these countries that come into this new crisis, or the Japanese version like the US, cannot afford it. So something needs to break, and something is breaking already politically, in my opinion, and that's what the US election about in 24. And ultimately, we will have a new capital structure and a re-engagement of the market as a distributor of goods. But we are 1-2 years away from that breaking point, but we're moving towards it. And right now, we're celebrating lower rates. We're celebrating that the inflation just seems to have gone by the wayside. But underneath that is that we are still imbalanced on energy sufficiency, cybersecurity, defense spending, social programs, as we just discussed. So the imbalance is just increasing. It's like a pyramid which is standing on its head instead of on a sort of the wider part of the pyramid itself. So it's in control right now, but it's escalated towards higher volatility.
Okay, well, let's stick with the 2024 presidential election. And another of your outrageous predictions is that Robert F. Kennedy Jr. may win that election. Now, here's the extraordinary thing, Steen, which is that last week's guest said that Robert F. Kennedy Jr. will change the conversation around the election such that we don't see either a Biden or a Trump presidency. So talk us through how you see that conceivably happening.
It really comes from the success we had in calling Trump winning over Clinton and calling the Brexit, which has nothing to do with our intelligence or our ability to predict the future. But we did realize in both cases that Mrs. Clinton was the most unelectable person ever in the history of U.S. elections. There was no way in hell that she was going to be voted into office, which meant that Trump was more likely than not to actually to succeed. Similarly, as you very well remember yourself, the Brexit campaign, the Yes campaign under the Brexit, was really talking down to people. They were really thinking that the UK voters were stupid. Coming up with numbers like you're going to lose 2,133 pounds over the next 10 years. And this is the same people that can't predict the interest rate the next 3 hours. So they sort of lost it and became an anti-establishment vote. It was never about the EU, in my opinion. If you fast forward that to 24, you have on one side a president, which in the consensus of the market, not my saying, but is anti-democratic. He's actually in court fighting the claim that he is anti-democratic. And you have a president who are more likely than not to die while in office, or at least cognitively disabled somewhat. That's probably 30% of the vote on each side, which is fixed before we start the election, which means that 40% is undecided. Into the mix comes a royal name in the US, maybe not to the young people, where I think Kardashian is more famous than the Kennedy family, but I think the Kennedy family comes with a royal brand. And as someone as a candidate, as you probably discussed last week as well, a candidate who is actually for everything. He's not against anything except war, which he wants to reduce the U.S. role in terms of the global policing they do. He was an anti-vaxxer. He was, and he's very much looking for electoral reforms. He is very much a guy who wants to go up against the pharmaceutical and the healthcare system, as we discussed earlier. He's a person who is populist in every shape and form that you can imagine. There isn't really, if I'm a bit harsh here, if I'm an economist or even a social economist, I don't think there's really a lot in the program. But the thing is, he is less hated. He's less not liked than Biden and Trump. I mean, Biden and Trump has their own candidacy, but I can easily see that similar to your guest last week, that at a bare minimum, he becomes an impact. He will definitely hurt right now Trump more than he's going to hurt Biden, because he appeals to the kind of same voters. And secondly, the last time an independent ran with some success was George Wallace in 1967, if I'm not mistaken. He got to 28% of the vote. Similarly, when Clinton won under Ross Perot only tallied about 8-9% in the vote, but it was enough to actually put Clinton in the seat and de-seat and dethrone Bush the first. So, these guys that come in from the part and independently can play a role. He is a national name because of his name Kennedy, and he is not someone that people feel is part of the establishment. And I think the US election, the upcoming UK election, the European Commission election, EU election that comes up, and all election that we expect during 24, I think will be driven by one factor and one factor only. It is not going to be on people selecting who they think is the right person to be in office. They're going to deselect everyone else first before they get to their candidate. And that is very much in line with what we saw in the Netherlands, very much in line with what we saw in Brazil, what we saw in Argentina. And I think continuously through this phase of pretend and extend into the final inning here, I think that is the driver. People are not voting for what they want. They're voting for what they do not want. And that is far easier for people to define, because that can be one single thing that they are anxious about.
Okay, so if you were to make a non-outrageous prediction about who would win the presidential election, who would it be?
Biden, simply because I think the power of the Kennedy name is enough to take enough votes away from Trump.
From Trump. So the most likely result is another Biden presidency. It seems extraordinary, doesn't it, from the outside?
It does. And it's a classic case of what I just outlined. It's not because people vote for him. It's because in this case, two other candidates is perceived to be worse.
And the UK election?
It's tricky because of the electoral system in the UK, where I think really the key component is the Scottish vote, which I think is, if I'm not mistaken, is 55 votes. I think they can really make a difference, and they're probably going to swing more Tory than the overall national polls show right now. So I think it will be a Labour win, but I don't think it will be outright as good as people expect, simply because the way you have constructed the election system in the UK. So to some extent, too many people will be anti-Labour for its history, and whether it's based in a rational or thought process is not is really irrelevant. There will be special interests that will play a key role.
It's interesting, isn't it, that going back to Scotland, that the SNP over the last decade or so have managed to convince everybody that Scotland is a uniquely progressive and left-wing society, whereas in fact it's just a split. If you take out the SNP, it's just a split in that kind of sense as the rest of the country.
And that is exactly the point, and very much vested in actually being part of the UK and not being independent, which of course. But you know as well as I do, facts doesn't matter in today's world.
They will matter again one day. Right, let's go.
That's what I'm
one day. That's what you're worried about, exactly. Let's go back to, we were talking about yield curve control, and we were talking about Japan, and you make a great prediction here that Japan will have a 7% GDP growth, which you call lucky 7 GDP growth, and that is going to force the Bank of Japan to abandon its yield curve control. We should just call it YCC. It's easier. How's that going to work?
Yeah, so I'm just back from Japan, and it's pretty clear to me that given the opportunity, Bank of Japan and the Ministry of Finance in Japan will slow walk the normalization of interest rate policy in Japan. They can't simply afford to pay the market price. With wages at 4% and inflation at 3%, the real rate in Japan shouldn't be minus 300 basis points. It should be plus 100 or 200. And it's not happening. Why is it not happening? Because of this yield control, so the artificially low interest rate. Lucky 7 addresses the fact that the number 7 is apparently a lucky number in Japan. So we sort of provocatively said, how about if nominal GDP reaches 7% because of these negative real rates they have? Makes the economy overheat, wages start to rise, which they already have done. And on top of that, I think Japan plays a pretty central role in the recalibration of the semiconductor industry. It's pretty clear that everyone needs and wants to get out of Taiwan over the next 10 years. One of the few places where you both have the technology and the the logistics to do that and replace it is in Japan. So Japan is on top of being top of the class in automation and robots. They're also now increasingly seeing these heavy investments into factories and semiconductor related industries. So I think Japan could see a very big headline number, which is asynchronic to the rest of the world, probably in 24. That will put pressure on the upside on the interest rate in Japan. And I think as an outrageous call, but also as a real call, the biggest single event risk we can look that we know of in 24 is actually if YCC is abandoned by Bank of Japan. That will increase the nominal interest rate in the world by anywhere from 25 basis point to a full percentage point if they let go, because as you know, Japan is the biggest marginal buyer of debt in Europe, in the GCC countries, and in the US.
Okay, so should we manically buy Japanese assets?
I think you have better than a 50-50 chance that your currency rate is going to be pulling for you and pulling pretty heavily. So it's a little bit binary. Either you're going to make 20%, 25% of the currency, or you're going to probably make a decent return on just owning the assets for the balance of the year until they remove the slow walking and start running to abandon it.
Okay, so we can be bullish on can we be bullish on Japanese equity markets as well as bond markets?
I would say bond market I've given up on, and I think every international investor has done the same. But I would say I'm definitely into a market which is running as hard as it is right now. It would not be a silly idea to buy yen calls against the dollar as a protection. It's probably a much better protection than buying a put on the stock market, because if Japan becomes the catalyst for change in the monetary outlook, it will have severe impact on the currency rate. And to the extent that dollar yen probably should trade 100 and not where it is today at 141.
Right. What next from your outrageous predictions? Let's see. Oil at 150. That's kind of interesting. How does oil get to 150 and stay there?
Over the last few days, we've seen that unfortunately, the Middle East crisis seems to be opening on other borders as well. There's been a dire warning from the Israeli towards Hezbollah in Lebanon. We have also seen that apparently the security apparatus now is telling Hamas outright that, similar to what happened after the Olympics in 1972, we're going to go after every single person who's in the leadership of Hamas, wherever they are in the world. So I think there is an escalation of the risk premium potential in terms of the Middle East. On top of that, I think the OPEC is very unhappy about their inability so far to actually to get the market to accept that they are reducing production. Obviously, the market is skeptical because the compliance is pretty low. And then, the third one, which is probably the more positive one, is that if we believe all of the interest rate that the cuts that the market is pricing in, we could potentially look at an acceleration in the second half of next year, both on inflation, but also on the growth side after seeing a pretty poor first half of 2024. So I think, if we go as deep as I expect in interest rate, I think that there will be some stimulus impact coming from that.
Okay, and then the Saudis buy the
the Champions League.
The Champions League, exactly.
Yeah.
Because
I mean, it's easy. It's easy to understand why. I mean, FIFA is up for everything that has to do with money, right? I don't think I'm gonna get sued for saying that, but let me take you through the story here. So we know the live golf tour was bought by the Saudis, and a lot of American golfers in particular been asked why did you join the live tour? I mean, it's an inferior tour in sporting terms, and whether you want or not, probably you're sanctioning some of the things that goes on in Saudi Arabia. And the answer back was very classical and very what an economic agent should say. They say, listen, if someone came to offer you 10 times your salary and in the process making sure that you were made whole for the next generation, maybe next 3 generations, why wouldn't you take the money? So really, again, what we are trying to provoke here is the thinking is theoretically, if the money is big enough, is everything up for sale? I think personally, unfortunately, along the lines we discussed a few times already, I think that is the case. There's a number of European clubs that if Saudi and FIFA came to them and said, why don't we replace the Champions League with a format where we three double the prize money and we make it a little bit more structured. You play a little bit less matches, and the final and the semifinals will be in the GCC. I think there will be gain, if nothing else, because they will argue simply to the American golfers that they have the interest of their supporters and their shareholders to heart.
All right, that's slightly outside my terms of reference. Anything to do with football, but I'm glad we covered that one. Can we move on though to AI? This is an interesting one. Tell us your predictions, outrageous predictions around AI.
What Peter Ganry, my equity analyst, did, he asked a very relevant question. What would have to happen for us to give guardrails to AI or to stop the progress into infinity in the uses of AI? And he came up with the answer, which I think is very classical. He said there needs to be a national security incident for this to be stopped in the process. We know the EU Commission and government will not be able to do it. First, they need to find a political mandate, and then the execution is difficult. But imagine, and this is just imagine, but imagine the National Security Advisor was caught on video and on tape and release of emails delivering information in a restaurant in Paris to his counterpart in China. None of it being real, but all of it done so well in deep fake that it would be very, very difficult for the National Security Agency and others to figure out what was really going on. That would, of course, raise the alert with them. And most likely not, they will say one or two things. First, they will immediately put a ban on OpenAI and Microsoft and everyone else to share their databases outside non-compliant parties that is not approved by the National Security Service, National Intelligence Service. But on top of that, it raises, and the positive impact of deepfake, of course, being, I had my Dutch colleague the other day send me an analysis in Danish. He doesn't speak Danish, but of course he used one of these AI deep fake things. And so the positive impact is you can do it and you can create sort of translation and wider material. But the deep fake is that we know it goes on already. I mean, imagine what goes on in terms of the intelligence service, in terms of deep fake, this, that, and the other. So I think this is a real call. The only way we get controls on AI is national security breaches.
That isn't particularly good for the AI industry and not good for the bubble, for the stock prices, etc. Suddenly, that's exactly the kind of thing that will destroy that bubble.
Absolutely. And we are not saying it's happening, and we're just saying that deepfake, in our opinion, is the single bigger risk for this potentially to happen.
All right. The last one that I want to ask you about, because I'm interested in this one, is luxury demand collapsing as the EU goes Robin Hood, introducing a wealth tax. And it's interesting. We haven't heard as much about wealth taxes over the last year or so as we did in the previous few years, when there was endless conversation about wealth taxes in across the EU and the US. And also we talked a lot about wealth taxes here, but it's a conversation that's slightly petered out. So I'm interested to see it coming back here in terms of a wealth tax on luxury goods. And there's been also lots of conversation, of course, about putting a higher rate of VAT on luxury goods. So how do you define luxury? We'll never quite know, which is the same kind of idea.
It's a great catch you have on it being less relevant in the narrative the last 2 years. And I think that's simply because the fiscal dominance was allowed to run. And don't forget, a wealth tax sits below one, jealousy as a psychological phenomena, but it also sits behind sort of a populist movement where a government is coming up short on tax receipts. The best way to make a most fair, in citation mark, way of reining in some more tax receipt is to go out to the wider public and say, listen, we're going to go after the rich. And what is kind of super ironic is that Norway right now is acting more like a communist country than the richest country in the world. As you probably know, Norway introduced a welfare tax, which made, I think, about 1,000 to 1,500 of the richest people leave the country. It's really punitive. And maybe that is the maxim that only the rich can afford to be socialists that is playing out. But the story here simply is, I mean, if we narrow it down, it's really government coming up short on tax receipt. What is the easiest, most popular, with the least amount of voter impact, maybe even with a positive voter impact that you can do, is of course to tell the 99% quartile, we're going to tax the rich more. The great irony being there is zero tax revenue relevant in doing it, but it's of course something that is perceived to be doing something, again, in citation mark, fair.
Yeah, and only the rich pay, and nobody thinks that they're the rich, so it's always somebody else who pays this tax.
Exactly.
But 2% is quite high. And it's enough to make people want to move very quickly.
It is. I mean, it was at 0.5%, and now it's at the 2%. And the problem is that welfare tax is kind of unfair. If you don't realize any money, you can end up in a situation where and even if you lose money year over year, you have to sell some of your assets to keep your assets. That kind of doesn't make sense.
Yeah. It's interesting. I had a guest on a little while ago who said that one of the things that they never bought was luxury goods companies, not because they worried about wealth taxes, because they felt that if you had any eye to ESG, the majority of the large clients of the wealth companies weren't people that you'd be happy to pop under your S. So it's not a reasonable sector to hold equities in.
No, I fully concur with that.
That makes sense to you?
Yeah, absolutely. I fully concur with that. The problem with E, S, and G is no company is all three. So depending on whether you go for the S or for the G or for the E, you're going to end up with very, very different economic environment. I mean, I don't think there's anyone that claims that Meta is very G. They may claim they are E, but they are certainly not G if you look at their capital.
And certainly not S.
And certainly not S, exactly. But nevertheless, if you find an ETF that is green or ESG compliant, you'll very often find Meta. So someone needs to explain to me how that works.
I don't think anyone can, and we're getting to the point where people are beginning to understand that the ESG are in the main in conflict with each other, right?
And going back to your other guest, I think the point really, the super point here is that S and G doesn't matter. It's only E that people are interested in. We're driving the value of E, but S, somewhat if it follows, but G, no one monitors G.
Steen, can I finish this conversation by asking you about your non-outrageous predictions for next year? Looking into the rest of this year, what is it that you actually expect to happen? What do you see happening in stock markets, for example?
So as you and I tape this, the market is full of conversation about that the central banks, ECB, Bank of England, and the Fed are fighting the market. The market is saying there will be more cuts than the central banks, and a lot of people are telling me that they are pricing it too much. I actually think it's the other way around. I think it's too little is priced in because the cut in interest rate that we've seen is really driving by a subpar performance on inflation. We're still to see the full impact on a very high for very long interest rate into the economy. So I expect the next sort of thing to happen is that we will maintain a low interest rate, a lower growth. But as we come into Q1 next year, actually real rates with the pace of which the Fed is indicating will rise to 325, 350 basis points. And that doesn't work. So if rates are going down, they're actually going to go down more in order to get real rates down to 100 to 150. That will be my number one focus on the positive side. On the negative side, I go back to Bank of Japan. Whatever Bank of Japan do will have a outside impact on the rest of the world. I don't think young people in the market today fully understand the full impact on the excess saving that sits in Japan and finances everything from tri-finance in ships and factories to carry trades in Aussie yen. I mean, if that flow reverses back, it's something that will impact all of us, whether we want it or not. So pretty much what we need to on the risk side needs to wake up to every day is checking the dollar yen rate and comments on the markets. But interest rate going much lower than the market expect, and it's particularly now that the market is saying, "Oh, this is too much." I wholeheartedly disagree. I actually think we need far lower real rates in the US.
Okay, so where should the retail investor put their money then? Do you think the ordinary investor?
In the UK, it's very simple. I mean, buy as much of 2 years and 5 years and 10-year government bonds as you can. The Bank of England this week was very slow in acknowledging what is going to happen. And what will happen is that because you had so idiosyncratic reason why your inflation went up, you're going to have the same idiosyncratic reason why it goes down. So as we come into sort of all of these things running out, regulatory and framework-wise in January and February, we would see a massive drop in interest rate. I will say there is a 10% return, which is close to zero risk in being long the bond market. That is for the taking, and I think people should put at least 50% on that into it. And then you need to address all the issues that we just talked about in terms of what is the world short of? The world is short of productivity, short of real solution to the real economy, and find some stock that sits in that sector, you're fine. If you buy stocks that are sensitive to the global economic growth rate, you're probably at risk. But your first part of next year should be pretty okay for investors. But I think the best assets, certainly risk rated, but also not risk weighting. I think fixed income is the way to play, and especially in the UK. Same for Europe. Germany needs a significantly lower real rate. Europe does it. US needs it. So wherever you are, but particularly for a UK investor, it's pretty clear to me they need to be long fixed income.
Okay, well, that is a great place to end, something positive and proactive for our listeners to do. Steen, thank you so much.
It's an absolute pleasure. And I think I'm the most positive person you ever interviewed, just for the record.
Yeah, you basically are, and it's not that positive. John, what did you think of Steen? I mean, again, we spoke to Steen last year, right? And you look at these things and they're supposed to be outrageous predictions and you read your way through them and you think, well, yeah, that could happen. That could happen.
Yeah, no, Steen's good value, and these predictions I always think are interesting. I mean, as always, there's a few that I think just won't happen, but there are the other ones where you're thinking, actually, that is it's quite hard to make that sound outrageous without, tweaking some of the language to drum. I mean, the whole thing about the one I thought was and you mentioned this in the podcast, but the Robert Kennedy thing about him kind of stealing votes from Trump. I mean, Pippa said basically the same thing just a couple of weeks ago before Christmas, and that one feels like quite a high possibility outcome. Well,
it is. I mean, as Steen and I said, you look at the current candidates for US president and you think, well, it's inconceivable that the greatest bastion of democratic capitalism on earth could once again elect either Trump or Biden. So something else must happen. Surely something else must happen.
Oh, yeah. And I think the Steen's point about people voting against someone rather than voting for someone is a really good one, and it's really overlooked. And I think one thing, because lots of people seem convinced that Trump's definitely got to win this time round, but they forget that last time round he was up against someone even more unpopular, whereas if he hadn't been, then he probably wouldn't have won that time. Yeah. And maybe it's the same this time round. Maybe.
Which brings us on to the end of capitalism in the USA. I mean, I did think this was really interesting because, this is possible, very possible. The US budget deficit is particularly high. The debt payments are off the scale, nuts. The amount of money that has to file out into debt payments. So there should be, or there will be, intense pressure to try and oomph demand for US treasuries. And that's particularly the case if one of his other predictions were to come true, i.e. the Japanese have to avoid yield curve, get rid of yield curve control, and you suddenly find a pile of bond market money flowing back into Japan and out of other bond markets, the US is going to be in a whole pile of trouble. They're going to really need to get people into treasuries. And so making income from government bonds tax-free seems like a pretty straightforward way to go, even if it does destroy capitalism.
Yeah, my one issue with this one is I'm not sure how that would go down really in the US.
Why?
I think because I think the US is still, at the end of the day, still quite an entrepreneurial place. It's still got a sense of the idea, the private sector being crowded out by the public sector. And I think that it's possible that a large enough group of people would see through that to basically, be against the idea. But I mean, that's more sort of like hope, placing my faith.
I was going to say, look at you with your faith in the people.
Well, maybe not the people, but the mentality. I could totally see it happening almost anywhere else, but I can see there being possibly sufficient objections to it over there. I don't know though. I mean, it's certainly not implausible, and it was scary. Actually, he's right. That would be, given that where interest rates are anyway, and the fact there is going to be a lot of competition for capital all over the place. You do have to kind of think that would be pretty damaging. But that's what you kind of hope that they would realise it would be damaging, because you can't if you're killing the golden goose just so that you can feed your creditors for a bit longer. I'd have thought the US would just be, if you like, arrogant enough to think, well, we're the US, we're the only country where MMT is feasibly, possible for a period of time. So
yeah, Steen was very end of times, wasn't he?
I mean, I like Steen, but he is sort of like pretty much the only mainstream person, or close to mainstream person, who's actually an Austrian economist. And Austrian economists are basically always end times, and I have a lot of sympathy for the Austrian view. But one of the things that totally disagreed with him on was the health thing and the anti-obesity.
Yeah, we nearly got into a bit of argy-bargy on that one, didn't we?
Yeah, aye. And I thought I was glad, because I was reading the transcript and I was thinking, I was getting kind of quite irritated, and then you came back and basically mentioned all the points that I'd mentioned, which was, this is, the whole idea that it's about kind of willpower, and that these pills are not side effect free. There is a high hurdle rate to wanting to take them in the first place, and nobody actually likes being fat at the end of the day.
Email, usual address, please, Director John, thank you.
Well, no, it's just another, it's just a very visible form of kind of weakness. It's like if I put on like a pound every time I drank a glass of wine, then I wouldn't be able to sit in this chair, and if, the real problem with all these other addictions like gambling and smoking is that they don't show on your body, at least, certainly not until it's kind of very late in the day, and also most of them have got a certain glamour about them, and unfortunately having an issue with food doesn't. So I don't think that people are going to give up exercising because there is a fat pill out there, because the consequences of taking it are already pretty significant. So no, that was one I disagreed with.
I know. I thought you'd take more exercise, because as you lose weight, you're much more able to take exercise, and people like exercise. But I suppose my issue with it wasn't quite the same as yours. It's just that we always tell people, or I certainly do when I'm writing my columns and when I'm arguing on people of Twitter, I always say to them, you may want something to be like that, but that's not the way it actually is. And we have to work with the way things are rather than the way that we want things to be. So Steen wants people to get a grip. He wants them to diet. He wants them to exercise. He wants them to do the stuff he wants them to do. But we know already that they're not going to do that. We know this doesn't work. We've got decades of experience in learning that nagging people to go on a diet and nagging them to exercise doesn't work, because it's incredibly hard. I mean, where does he think the diet publishing industry came from? If diets worked, there'd only be one diet book.
Yeah, and there'd be no self-help books if people were able to help themselves.
No self-help books. Absolutely. You just need the one. So you can't work with how you want people to be. You have to work with human nature. And that's, I think, what these drugs do. And so they seem to me to be a rather wonderful thing. But, there you go. There's so many different opinions on that particular one. But a lot of what Steen wants is people and economies and businesses and governments to behave in a rational way. And he sees, I think, an end game where people will behave in a rational way. And I'm not as confident as him in that end game.
Well, that is the classic kind of Austrian perspective, that you should be sensible.
Everyone will suddenly, there will be a crisis. Yeah, you should be sensible. There will be a crisis, a horrible crisis, an endgame that will make everybody see sense. And then things will be better. But we're bad at seeing sense, aren't we?
And this is the other, you just have to muddle through. There is no end game. I think all end game thinking, from the stuff I do have sympathy with, like the Austrian thing, to the stuff I don't have sympathy with, like we're all gonna die like imminently because of climate change, as opposed to maybe in hundreds of years or something like that.
I try so hard not to get onto climate change. So hard. I
know. Sorry. That was it was probably a bad example. But what I mean is, like, apocalyptic thinking is never helpful, regardless of the truths that are within both of those views. When the Austrian view is right, there are lots of things wrong with the way that we've got our economy running, and it feels like we will get to some point where things have to change again, but they won't end. They will just change. It's like the world didn't end when Britain no longer was the reserve currency. It just became something else. And probably over time, the US dollar won't be the reserve currency anymore. It'll be something else. But all it'll be is a change rather than a kind of, a wake up where we all suddenly start acting in a sensible way.
So John and I, we have a prediction, don't we, John, for the year? There's a lot of forecasts out there at the moment. Everyone's making their predictions. Some are dramatic, some are not. But John and I would like to predict another year of muddle through. Is that fair, John?
Yeah, actually. Yeah, this year. Yeah, definitely.
John, one last thing I wanted to mention about Steen. I totally forgot, and apologies everyone, I completely forgot to ask him about Bitcoin or gold. So I did talk to him briefly afterwards about whether he would have chosen Bitcoin or gold had I asked him the question at the right time. And his answer was pretty simple. He said if he was young, if he was below 30, he might have more of a think about Bitcoin. But we didn't really get into that, which is a shame because I'd like to know why. However, his actual call would be gold. In a world, he says, with more debt and less tangible asset to back it, I think gold will fly. When one cycle ends, i.e. a hiking cycle, and another one starts, gold and commodities. So long gold for the next 10 years.
That makes sense.
Does to us.
I'm just wondering if the reason he thought that his younger self would buy Bitcoin is because he thinks his younger self would be stupid.
I'm going to get a special hate mail email address for you, John.
I look forward to it.
Thanks for listening to this week's Merryn Talks Money. We'll be back next week. In the meantime, if you like our show, rate, review, and subscribe wherever you listen to your podcasts. And please do talk about our podcast with your friends as well. The more listeners, the better. This episode was hosted by me, Merryn Somerset Webb. It was produced by Simon Sardi. Additional editing by Blake Maples. A special thanks to Steen Jakobsen and, of course, to John Stappak.